In this presentation, we will continue on to part 13 of our C Corporation comprehensive problem. This time we're going to fix the beginning balance error that we had in a prior presentation related to depreciation. We'll also have an alternative method to adjusting the book depreciation that we showed in a prior presentation as well that might be more transparent, longer, but more transparent. Here we are in our form 1120. What we're going to be concentrating here on is the depreciation. We're going to say, okay, we had a review process here, and we'd realized, and it was a little frightening for us for a little bit here, that the beginning balance for the depreciation was not input properly. In other words, if we take a look at our depreciation schedule and scroll to the right and then down, we want to get to that grand total depreciation was at the 309,387. Let's put that in our trusty calculator. So that's going to be basically our beginning balance before the current year information was at the 309,387. And I'm going to say what is on the current balance sheet. If we go over to the balance sheet and go to the 1120, page 6, we have the beginning balance here of the 289,387 minus the 289,387. Now those two should, of course, match. They don't, because when we entered the beginning balances, we miskeyed one of the depreciation beginning balances, and this item we hard-coded. So they don't tie out by the software because that beginning balance is hard-coded in the balance sheet. In other words, if we go over to the balance sheet over here, and we go to the balance sheet data input screen, balance sheet data input screen, then this beginning balance was hard-coded, and so it cannot match the depreciation schedule, and that could be a problem. So in the review, we're going to say, oh, now there's a miskey in the depreciation. So I'm going to go back over to the forms, and I'm going to go down to the book depreciation. This was a book depreciation, not a tax depreciation problem. And scroll back down, and the miskey is here. This 289,387, when we had our beginning balances from the schedules that were provided to us from a prior system, we're going to say these came from the prior tax preparer, and this is the prior system that we entered into place, even though it says 2019, we're imagining they're 2018. And it should have been the 269,387, not the 289,387. So in the larger piece of equipment, it should be the 269,387. Now, everything should tie out because this is the prior year balance, so we should be okay to adjust that. I'm going to make the adjustment to this number, this beginning balance, and we should be okay. We should be still in balance here, and everything should tie out given the fact that the balance sheet is correct. Let's do that. I'm going to go back into the detail. We're going to go into the deductions. Depreciation, it's going to be the second piece of equipment. I'm going to scroll down to the prior year book depreciation, and it shouldn't be 289, but 269. So it should be 269,387 as shown here, 269,387. All right, I think that's okay now. So now let's go back to the forms up top, and we're going to say, all right, so that's going to be the 269,387 here. Then the total prior year depreciation should be the 289,387, which is what we had in our data. The 289,387 should be the total. Okay, so does that throw us off in any of our information on the 1120? We're going to say page 6. Does it throw anything off here? No, it doesn't. Why? Because again, this beginning number was hard-coded. So that beginning number was right. The ending number has been adjusted by the tax return, so it is being calculated by the depreciation schedules. But you got to get that base number right within Lacerte to make sure that it ties out to the schedules, so that the totals then would tie out. So let's also take a look at an alternative method for the calculation over here. We had number 9 is where we basically made an adjusting entry for the depreciation schedules between the cost of goods sold and the depreciation. And we said there was an adjustment of the 1724. Now we kind of backed into that adjustment. We could have done it in a more transparent way. Also want to show that kind of more transparent way because I've been kind of advocating doing more transparent journal entries, even if they're longer, because they're better to go back and be able to see what happened and review at a later time, and they're also easier for someone to follow if you were to have someone else do your tax return or do the same return in the following year to try to see what happened in the prior year. So let's take a look at that same kind of journal entry. We're going to say that There's an cost of goods sold portion of depreciation, the depreciation, and then the accumulated depreciation. And this is what we did back in the comp problem 9 video. And so what we're going to do now is say, let's get more detail in terms of what the exact journal entry was that was done for the book basis. In other words, we believe there's going to need to be an adjustment for the book depreciation because we know that this amount right here should be, if we go back to our schedule here for the book depreciation, and the current year depreciation should be that 2,976. And what we did, if we go back to Excel and the prior and number 9, if we go to number 9 instead of number 9, the alternative, we made the adjustment, that adjustment being the 1724, to reduce this amount related to that piece of equipment down to the depreciation of 2,976, the other side going to the cost of goods sold. So we kind of backed into that adjustment, what that adjustment needs to be. Now, what we want to do here is think, well, how can we do that in a little bit more detail, a little bit more transparent way? What we would want to do is say, what's the actual journal entry that was recorded for depreciation by the books? If there's a problem with it, by the bookkeeping department of the client, let's reverse it and then put the correct, what we believe to be the correct journal entry to record depreciation in place. In other words, the depreciation journal entry would typically be equal to, if we say, would normally be a debit to depreciation and then a debit to the amount that's going to be in the cost of goods sold for depreciation, the depreciation component of cost of goods sold, a credit to accumulated depreciation. Let's find that depreciation journal entry in the system, which means we would go to the GL account, the general ledger, see the activity for the accumulated depreciation, which there should be very little activity, just journal entries for depreciation, possibly monthly, and see what the transaction is for the accumulated depreciation. And if we go in there and say, okay, let's say we find that the transaction looks something like this. We have the debit to cost of goods sold, as we saw what the format would be, a debit to the depreciation and a credit to the accumulated depreciation. So once we see that, we can say, okay, let's just reverse entirely what the bookkeeping department did because we think there needs to be an adjustment to it. Instead of just recording the difference between the two, which would be a nice simple, I'm going to go back to what we did do last time, a nice simple small journal entry. Let's record a longer 2 journal entry process so that we can see the detail. We can see more detail of what we're doing. So I'm going to reverse this, and we could put this in the notes, and we could say, all right, I'm going to go back up here, and I'm going to say this is an adjusting entry, and I might put in the notes to say new note to reverse bookkeeping or client depreciation journal entry so we can then correct it, right? We're going to reverse the entire thing and then correct it. So I'm going to say then we're going to credit, and notice once again, I'm going to put the credit on top because I think it's easier to see the depreciation journal entry as you normally see it. So I'm going to say, which is debit depreciation, credit accumulated depreciation. So I'm just going to reverse this transaction. I'm going to go all the way down here. I'm picking up that 20,000 that was recorded. And then I'm going to say pick up with a negative of, we're going to pick up the cost of goods sold portion. So I'm going to scroll back down and pick up the cost of goods sold portion. And then the difference is going to be, I could pick this up down here. The debit was for the 238,690. So there's going to be our transaction. So now I'm going to reverse what the client did, right? So I'm going to go down here and say, let's post this out. Here's the depreciation. Let's reverse what was input into the system. And so I'm going to be in 029 equals, scrolling back up. We're going to pick up that 20,000, bringing it back down to 0. Then we're going to go to the cost of goods sold. So cost of goods sold is here. I'm in 023 equals, scrolling back up. We're going to pick up that 218,690. So that brings it down. Now we're in the accumulated depreciation. Here's the accumulated depreciation. I'm in 012 equals, we'll pick up that 238,690. And there we have that. So now we've reversed what has been put in place. We're back in balance down here. Now we're going to say, okay, let's reconstruct this according to the depreciation schedule. So this is going to be an adjusting journal entry, not a tax journal entry. I'm going to put a note. I'm going to right click and say, let's put a note in there to record book depreciation, not tax depreciation, according to book depreciation schedules in the tax software. So we're using the tax software to calculate the book depreciation because the software needs to do both in order to calculate the difference. So that's a good tool to use then. So we'll go to the tax software and say, all right, well, what's, and the journal entry is going to be the same format, right? We're going to debit depreciation expense, debit cost of goods sold, credit accumulated depreciation. And let's go take a look at what we have now in our book depreciation schedule, which has now been corrected for the prior balances, but we are recording the current depreciation, so it shouldn't be a problem. So we're going to be picking up the current year depreciation. We have the two components. One's going to be the depreciation going to the book depreciation for the 20,000 recorded to the first page of the 1120, or recorded in the 1120. That's going to be the 2976. So I'm going to go back over and say, okay, the depreciation is going to be the 2976. And then we're going to go back over and say that the other piece is going to be machinery and equipment, which should be 235714. So we're going to say this should be 235714. Notice we have a difference there between these two. Sometimes that can happen if they're using a different method to record depreciation, or possibly we give them the depreciation from the accounting or tax department as we go, because we enter their information into our tax software in order to help them with their book depreciation, possibly to do that. Maybe something got data input incorrectly, quite common. And so let's reverse what happened and then put in the proper amount. So then, therefore, negative sum or plug formula, as I call it, is going to be the negative of those two. So there we have it. Now let's re-record this with the proper number. So we're going to say that the depreciation down here is going to be in this account. I'm going to double click on it, go to the end of it, say plus, put the cursor back down. We're going to pick up that 2976. So there's the 2976. Then we're going to go to the cost of goods sold. Here's the cost of goods sold journal entry. We're going to be here. There's the cost of goods sold. Double click on it, go to the end of it, plus, put the cursor back down, pick up the 235714 and enter. So, and then the other side, going to accumulated depreciation, which is here. Double click on that, go to the end of it, plus, and then we're going to pick up that 238690. So we're back up to the 505,101. Now note, there's no difference. We ended up with the same journal entry, which is basically just a debit to cost of goods sold and a credit to the depreciation, as we did in our original journal entry. Same result down here. But notice this, and you might say, well, this is way better because it's only got, one thing happening here. But again, if I was to interpret how this came about, like if I wanted to tell someone else how this happened, I'd have to write like a couple paragraphs of notes. I'd have to say, well, I'd have to say, well, this is what was recorded by the client, debit, credit, and then we reverse, and basically this is the difference between that journal entry and the current journal entry, which is really the debit, credit of this. That's the only way to really explain what you did, with this journal entry. Whereas if you do this, you really don't need any words to explain it, because this little note that just says, hey, I'm going to reverse what the client did and then put it in there in the proper format, just like any kind of adjusting journal entry would be, is more transparent in just the journal entry format. So it takes less notes to do it this way. Although it's getting to the same result with a lot more accounts, it's more transparent just in the face of the journal. It's easier to read for someone that sees the debits and credits and can read the debits and credits. So that's why I would recommend the more detailed method of something like this, if it were to make it easier for someone to see more transparently, without having, in this note card, I shouldn't have to write, a page worth of notes here to tell someone, what we did. If I can put it in terms of the format of the journal entry, that would be a faster way to go, in my opinion. So now let's just kind of double check the numbers that we have here. I'm going to go back over to the tax return and we'll say, all right, well, where should we be? Bottom line, book depreciation, this is what should have basically helped us to catch before the fact that the beginning balance was off. We didn't do a thorough job of checking the full depreciation. We were just looking at the current portion, right? If I take a look at what the accumulated depreciation should be at the end of the day, it should be the 269,387 plus the 235,714. that's going to be the 505-101. So we're going to say, all right, does that tie out? We got the 505-101. That looks good. We see that we have the 2976 here. The 2976, that ties out up top to this number. It's a little bit more difficult to tie out the 235714 once again, because that's going to be part of the cost of goods sold calculation. So it's included in the components of the cost of goods sold. If we go back up top and take a look at the balance sheet, and we then go to the page 6 on the balance sheet, scrolling down, we're going to say, do we still have, there's the 505-101. So that's the 505-101, which is going to be on our balance sheet up here. So that looks, now note when we're looking at these numbers, of course, we're up in part number 13. So we've entered these other transactions. So we're not matching up, even though this is the ultimate 9-2. When we go back to the tax return, we're up past number 12. So just keep that in mind when we're checking these numbers. But these numbers tie out in terms of the accumulated depreciation. So everything looks pretty good there. We're good to go forward. And again, I think whenever you can put in the more detail and be more transparent is probably the better way to go in the long run. If you go back and take a look at your notes and you want to make it as transparent as possible, so that if you look at it 3 years later or someone else looks at it, they can pick it up and just save time to do that.